Hi, everybody, and welcome to today's Roundtable on raising in a bear market. I am David, and I'm joined by my dear co-host and co-founder, Andreas.
Yes, and today we have with us some of Europe's very best and very most active LPs. And three of them are actually repeat offenders here on the podcast. We've got David Dana, head of VC investments at EIF. We have Michael Sidgmore, co-founder and partner at Broadhaven Ventures by Broadhaven Capital, calling from the US. And then we've got Joe Schorge, founding partner of Isomer Capital. And then we have with us a very new face to many of you, and that is Christian Roehle, head of investment management at KfW.
Before we start, we just want to give a massive shout out to the sponsor of this roundtable, Affinity, without whose continued support we couldn't dedicate all our time to create content like this roundtable for you. So if you're not yet a client, our message is clear. Do reach out, say thanks, and consider if their platform is for you.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
United and determined, we can serve as a model for other regions of the world.
The nature of a problem requires a European response.
Europe is a story of new beginnings, new beginnings.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
We just gave you a very short intro, but I do think that we should let everyone in the audience know a little more about you, especially because we know that the audience are probably all about to raise or out there on the trail now. So it is probably the best service we can do to anyone to let you all share a bit about how you're investing, what you're looking for, what type of fund you're investing out of. And Joe, you being very much connected to the disclaimer that we just said, because we're VPs with Isomer Capital, full disclaimer there, out in the open. I'll ask you to be the first one to tell us what exactly are you and Isomer about.
Well, thanks. I'm Joe Schorge. I'm founded Isomer Capital. We focus from the beginning and to today on Europe exclusively, early stage. We invest in funds, we co-invest with them into companies, and we buy secondary pieces of both together with our GPs. We've invested in about 75 funds so far. And because we focus on the early stage in Europe, that means we invest in lots of emerging managers. We always say, if you're on fund 10 and you're still doing that pre-seed, seed, early stage investing, we'd love to continue with you, but funds tend to get bigger and later. We have about 2,000 underlying portfolio of companies covering 38 countries at the moment. Pretty broad view of Europe. And that's Isomer.
That is Isomer. What a beautiful beast, as we always say. Michael, I'll ask you now to tell us a bit more about Broadhaven Ventures.
Yeah, hi everyone. I'm Michael Sidgmore, co-founder and partner of Broadhaven Ventures. We're a global early stage fintech investor that we do three things. We invest principal capital into fintech companies globally, a number of them in Europe, most recently 73 Strings, which we did with Blackstone and Fidelity International. We also invest into VC funds, mainly outside of fintech financial services. There are some overlaps, but it's mainly to get exposure outside of fintech financial services, but help asset managers build their business as we believe they're founders as well. And then incubate companies as well, current of which is a GP staking fund called Cantilever, which we're doing with one of our partners, who is a partner at Goldman for that. And we're collaborating with BTG Pactual on that as well. So we'll build and incubate asset management businesses. We're built on top of a fintech investment bank that my partner started called Broadhaven Capital Partners. It's advised on over 90 billion of M&A transaction volume. Most recently, the Franklin Templeton deal with Lexington Partners and TPG's acquisition of Angelo Gordon. So we have a bunch of exposure and experience in the alt space from that perspective. We spend a lot of time looking at Europe. We like Europe both on the direct side as well as on the fund side. On the fund side, we've invested in the likes of Goodwater, Lower Carbon, a few crypto managers like Polychain and Boost. And then in Europe, Tiny, Passion Capital, Firedrop, and have looked at a number of others, and some of which other panelists are investors in and really like the ecosystem. I went to LSE, lived in London for 5 years. So really think that Europe is in a really interesting spot right now.
And then you're also a fellow creator with Old Ghost Mainstream, and you are both doing a podcast and newsletter. So anyone interested in, how should I call it, the more institutional perspective, maybe, Michael, can I say that? And the alt as a broader asset class than just venture, definitely tune in there. It's an amazing newsletter. Weekly, it comes out with quite a few rundowns that I don't see many other places. And your deep dive conversations are, for any LP, really, really worth a lot, I find. So, Michael, thanks a million for being a creator and helping us all evolve the ecosystem. Now, Mr. Christian Roehle, I will ask you to tell us about KfW.
Thank you so much. KfW Capital is an investor in German European venture funds. I'm heading the investment team of KfW Capital, and what we do basically is dual fold. So we want to improve the access of capital to German and European startups, and at the same time attract additional investors to the asset class, hopefully. Maybe as a little bit of background, while KfW, some of you may be familiar with it, is Germany's state-owned bank, and it's actually just celebrated its 75th birthday. KfW Capital, the company I work for now, is almost a startup still. We were founded in 2018 and basically were put in charge of this investment program, where we basically invest around 500 million per year into funds. And we've built a portfolio of well over 90 funds on our way to 2 billion assets under management. We invest stage and industry agnostic, from seed to growth, life science, software, climatic, whatever enters our deal funnel. And we have a performance-based selection process. The idea being that good managers will be able to pick, hopefully, the startups that will deliver economic growth and employment to the ecosystem.
And now, David Dana, tell us about EIF. Not everyone knows you as well as this group here, so tell us everything.
Sure. Thanks for having me here. So basically, the European Investment Fund is a European institution based out of Luxembourg, and we are a part of the European Investment Bank Group. What we do at EIF and what we are known for is investing into VC funds across Europe, and more specifically across the European Union, because we are investing and managing European public money provided by a number of counterparts, like the European Commission, the European Investment Bank, a number of governments, ministries, regions, group of regions. So all in all, we are managing more than 50 different mandates that we are investing into VC funds. Over the years, we have invested into more than 700 VC funds. So we have a quite extensive overview of what is happening in Europe. And we have been on the market for more than 30 years now. So we have been seeing a number of phases and cycles, and the current situation that we will come back on is maybe a bit different, but still we'll see how it will evolve. But basically what we do is that we back emerging teams, established teams, to the extent that they can achieve our objectives, which are a combination of financial returns, but also policy objectives. And by policy objectives, we mean that the ones we have in our statutes at EIF are about supporting innovation, research, and job generation within the European Union. So this is one of the preliminary elements we look at, and then we go into deep analysis on each and every proposal we receive every year to make a selection. And on average, we invest a bit more than 3 billion euros every year into VC, and it is dispatched between 80 to 100 VC funds every year.
So with these introductions out of the way, I hope that to anyone listening in, it's quite obvious why we brought this gang together. The amount of capital being deployed here is incredibly relevant to anyone, navigating the current market or raising a fund or raising a second-time fund, first-time fund, whatever that is. And we'll deep dive into, the state of the market, important considerations around that, how other managers or stuff we're seeing other managers doing, and so on and so forth. So I hope you enjoy. To kick things off, let's put it like that. Michael, you are the less European-centric guy here. So I'm going to start with you on this one, which is, what are your views on the current state of the market? Is it as grim as some say? Do you see a light at the end of the tunnel? And feel free and please do share as much as you can from also your conversations with other LPs as well, in terms of deployment rates and what they're seeing and what they're thinking.
We have an interesting perspective because we're both a direct investor in companies, and I'll lead seed rounds. I led 6 seed rounds. I sit on boards with a number of VCs, and then we also obviously invest into funds, mainly emerging managers, so raising their first or second funds. So we see the fundraising journey that they're going through, and the difference that it's been kind of 2020, 21 versus today. I think it's a different environment than it was a few years ago. However, having said that, I think both good fund managers and good companies are still able to attract capital. I think it just may take more time for them to do so. If on the LP side, if people have not yet had existing relationships, it's harder for them to get started from a cold start, right? I think we're seeing a lot of re-ups and people, particularly on the institutional side, we see the institutional world, both from the podcast that I have, where talk to a number of institutional investors, CIOs of endowments like CalSTRS, et cetera, as well as a large portion of the wealth channel in the US, large wealth managers, platforms, et cetera. People are willing to re-up with existing managers because it's easier to do so. And I think they have familiarity, but new relationships are taking longer, which I think is, probably net positive. It means that I think, allocators and quite frankly, either funds or companies have a chance to build relationships and actually properly evaluate the opportunity in business relationship. I can tell you from the direct investing side, there were times when we had days to make a decision, particularly if we weren't leading around. I think that's pretty unhealthy. It happens at times. And I'd say one of our best investments, a company called Nowports, we had to make a decision in a week. And it turned out to be one of our best companies, led a seed, and I'm still on the board. It's at post Series C now. So that can happen. But I think generally speaking, it takes a little longer to make decisions. And that's, I think, a positive thing going forward.
Yeah, I just agree with all of that. And we were being pushed, I guess all of us were being pushed maybe a year ago to make decisions very quickly with FOMO kind of fundraising. And I don't think that's healthy either. I always think, particularly on the fund side, we're getting into partnership for at least a decade, probably longer. So I really don't like this kind of fake urgency, shall we say, created, and even worse on the company side in and around now. And it's super cool that one of those decisions turned out great, Michael, but they can also turn out not great because you didn't have time to do a full proper DD. So personally, I see everything slowed down, and I'm really happy about that. Not because I think markets should generally go slower, but because you have time to do a proper job of it. And everybody around the table has that same expectation. We will take time, we will be thorough, and that feels much healthier. I think health is a good word, a much healthier way to go about this business.
David, because you're investing a bit out of a different perspective, and sometimes you do have strategic agendas also driving you at EIF. So I'd love to ask you both, how did you deploy through the period, and how are you deploying now through this period? Because I always remember back in my early days in VC here in Denmark, I was with a fund that was backed by the Danish government, where we always said, and many of our entrepreneurs said, that we were so instrumental in that period where everyone hesitated because the market was down. And I'd be curious to hear, what have you seen through this cycle that we're in right now?
I think something which is very true in what you say, that governmental money, as we are at the end, and public investors, contrary to purely private investors, we also have a duty to support the market when cycles are going down. And this is also a reason why we have been continuing massively investing in the market. With some changes indeed, as you rightly mentioned, because there are some expectations for us to be more active on the climate, for instance, topic or sustainability, more than what we used to do in the past, or to focus on some new, what we call disruptive technologies, typically deep tech, kind of focus on, space tech, AI, blockchain, quantum technologies, all that kind of things, which were maybe less of a focus for us over the last decade. But what is very true at the same time is that our role has slightly evolved, meaning that we at the IF, together with other entities like KfW, BPI, and other public investors at a more national level, we have always been very important, notably to achieve first closings. Now, more than that, we are important, I think, just for a fund to become alive, because we have seen a lot of failures as well. And even with teams which had in our assessment, very good and strong potential to deliver, it has become even more harder than what it was in the past. Just to give you an anecdote, but a couple of years ago, I was at a conference, and I was really surprised to see how many funds that we had declined managed to raise significant funds, which was a good sign for the market. But there were a number, maybe tens of funds that were declined. We declined a lot, but tens are thinking about this specific conference that we rejected, and we had a quick catch up in the corridors, and they told me, we closed the fund at 150 million euros, which was great for them. I don't know yet about the financial outcome, but this we will see maybe later in a number of years. But it was very striking to see that they managed to do it because there was a huge interest of many, many LPs, most of them being very new in the sector as well. Whereas now it has dramatically changed. The best ones definitely continue to raise, maybe in a less speedy mode, which is good. But for the ones which are a bit more at borderline, I would say, or very innovative, it has become harder than ever.
Christian, I'd love to ask you to comment on this. Did you also see/feel the same as David just described?
Yeah, I think overall I fully agree, and for us it's the same. So we're basically still very much committed to the market and continue to deploy. One thing that I think is quite important is that what the private investors do, though, is absolutely important to us because we run a private pari passu investment program, which means we always require 50% private investors. So we like to monitor what the private investors do very closely. And you cannot basically ignore that there are some detrimental developments going on, right? Because the mood is not where it was. Of course, the public markets have gone up, so I guess the denominator effect has receded somewhat. But still, I think a lot of LPs took very huge sizes of investments in 21, 22. So they're still sort of over allocated. Then there is a crunch because there's not enough DPI, right? So there's another issue for private investors to do follow-ons. And the alternatives have become a lot more attractive in the fixed income area. We still see that there are fundraisings happening, and I think the number of successful fundraisings probably hasn't declined as you could have feared, but it takes a lot longer. The fund sizes are coming down, and I think all those aspects are quite dramatic if you want to set up a new first-time fund, right?
As the young guy in the panel, I just love to ask the four of you, and feel free to take it, whoever has the burning ache to answer first. But is this something that you feel is just another, it's just another cycle playing out? So you've kind of seen it again, nothing new. It's just kind of, remembering what happened in the past and, just kind of learning from that. Or are there specificities to what we're seeing today that are very unique and different that require a bit more, let's call it, mental plasticity / flexibility to navigate?
I think, if I may, something which is very important, at least at the European VC level for me, and based on what I've seen for the last 13 years at EIF, is that there has been a consistently exponentially growing market, which attracted a lot of money. Performance was looking super nice, very high, but most of it remained unrealized. So combining this aspect together with the current geopolitical environment and all the other risks associated to that, inflation and whatever, it makes it super hard. Alternative investment is super risky. Private equity within this is even riskier, and VC is the riskiest asset class within AI, in my view. So combining all those elements, if you go and ask a typical institutional investor to put money there, they have to make sure, to the extent possible, that they will get higher return out of it. And this is something which so far has not been proven enough, I think, in terms of purely cash to cash. And now what we need for sure is to continue on that front to attract and to require specific percentage of funds to be funded by private investors. We have some specific exceptions in some of the mandates we're managing, where it can be that 30%, for instance, of private money would be sufficient, where we can go ourselves up to 70% of the fund size. Is that good? I'm not sure, but this is necessary, at least for the time being. So if there's no understanding on the market that there's a need for private investors to come, not only for financial returns, but also for some corporate or other entities for more strategic investments and cooperation, then there will be a failure, in my view. But I think that's something all of my fellow colleagues here on this panel can also comment on.
Well, my take on your question, David, is I think investor behavior doesn't change. People are people, and capital deployment is capital deployment. However, Europe has a specific set of circumstances. The whole VC ecosystem rebooted after the financial crisis. So we've had this long, 12, 13 years of growth on growth on growth. And that's very different than the US, where you've had multiple cycles, but you didn't have this kind of mass reboot. And picking up on David dropped a very important point, but he went by it too quick. Many of the LPs that have joined in the last 10 years, it's their first entry into venture capital. And I think if you haven't been in this market for a long time, you don't really understand it takes time to build companies. This DPI point, it's important. Everybody's talking about it, but you as an LP, you must have patience. And if you just entered in the hype cycle, reading on the FT every day that everything goes up, well, now things are going down a little bit. And for long-term LPs, that's normal. That's coming. But what I'm seeing is a lot of these newer LPs are saying, well, we thought, this just went up. There's no such thing as gravity. And maybe I actually want to sell because I shouldn't have gotten into tech or whatever. So I think, there's some secondary coming because of this phenomenon in Europe, which is different than the US. You have a lot of LPs that have been in it for 20, 30, 40 years who behave differently.
Yeah, I think as the outsider looking in, I'll add 3 points, starting with one that I think is related to this in terms of the trend of private capital moving in. My perspective on this is somewhat informed by I built the sales team at iCapital with 2 others early days. So they have a big presence in Europe. And I think what we're seeing, and this is a secular trend, is that the wealth channel is picking up the slack for the institutional channel, maybe not allocating as much because of the denominator effect or they don't want net new relationships because they have a ton of relationships into private markets. Now, I think that will take time to mature and evolve. Not many platforms are necessarily working with emerging managers in particular because they have standards. They're working with the big brand name managers, or a lot of the wealth channel, whether it's family offices or the wealth managers, RIAs in the US, IFAs in UK, Europe, et cetera, tend to work with more established managers to get their feet wet. But I do think that that's a trend worth noting. And I think that over time, that will be a positive thing for any ecosystem, whether it's the US, whether it's Europe. I mean, there's a ton of capital that needs to flow into the alt space from the private wealth channel. Average wealth manager in the US is 1 to 5% allocated to alts compared to the institutional investors, many of whom some of you have them as LPs, 20 to 30+% allocations to alts. So I think that's an important trend to think about. We see that happening more and more in Europe. A lot of the private banks are thinking about this. So that's one thing to think about when it comes to fundraising. I think 2 other things from the outside looking in as a US investor that make me excited about Europe, despite the fact that the market may have changed, both US, Europe, et cetera, is one, I think, particularly at growth stage, you have been seeing more US funds come to Europe. They're planting flags on the ground and they're putting capital into the ecosystem. Sure, I think there's been data that's shown that they've pulled back in the past year or 2. We've seen that in other regions of the world, but I think that will come back faster because the European ecosystem is more developed and there's a clear path to exits or a path to European companies. Well, they don't necessarily need to move to the US to build big outcomes. You certainly can go that way. So I think from that perspective, as a US investor thinking about Europe and spending time in Europe, investing in it, I think the fact that there's plenty of other US investors really thinking about this, focusing on it, and dedicating time and resources to it makes me think long-term Europe's in a very good spot. And then the other piece is, this is more anecdotal, but really strong talents coming to Europe. We're investors in Sorare. Their head of people joined from Lyft, was first head of people at Lyft. And, US, someone from the US hadn't spent time in Europe, thought that this was a great opportunity and could have had other opportunities in Silicon Valley. Same thing. I've had a number of other friends who've from the US decided to join European companies because they're really excited by the opportunities there. So I think the fact that there's talent coming into Europe from not just the US, but from anywhere, I think bodes really well. And then you all know the statistics, right? There's more developers in Europe than there are in the US. Others have said this. So I think there's great universities, particularly for developer and engineering talent. So I think long-term Europe will be in a very good spot.
I have to plug you in here, Joe, because what Michael told is just now I almost felt like it was your story, Joe, coming from the US, recognizing the power of Europe and doubling down on it, seeing both the tech talent, but also the amazing innovation happening everywhere here. But that's the story of Isomer, of course, and you, and that goes back decades. But you're actually seeing exactly what Michael is saying, that uptick in interest around Europe in the US amongst the larger LPs is really happening now. Could you share us a bit more on that point? And also, because to our audience, Joe as a fund manager is raising capital, of course, as well, just as you guys are. And for that reason, also ask you, Joe, could you just reflect a little bit and share some learnings on being a European, selling Europe in the US? Because that's, of course, where we see many European managers thinking, maybe that's the next frontier for me to raise.
Yeah, we see all those effects that Michael described, which I consider second order effects. So if you have a productive, successful environment, it will pull talent, it will pull capital, it will pull. So that's happening. And that's, to me, the evidence of success, which is drawing in more talent, more capital. And as we know, labor and tech are very mobile. So yeah, and we have some American LPs. We market a little bit in the US, and year after year after year, the word is getting out, shall we say, to the point where I think many people think, if you consider your venture allocation on a global basis, if you're not doing something in Europe, you're really missing out. And that's, you can look at the PitchBook data and the Preqin data and the Cambridge Associates data, and that's pointing you to what David was talking about earlier, which is there have been great growth for now, not 1 year, 5 year, but more than 10. You can criticize Europe on DPI, I think, but that's also a feature of a younger ecosystem. My only real criticism would have been when we were up high in valuation terms in 21, first half of 22. I wish VCs had sold more. And I had a lot of active fights with them saying, I know you feel that it'll rise forever and you're an optimist. That's why you're in VC. However, take some risk off the table, sell down, return some cash. So, my criticism of Europe is we probably didn't do enough of that. But that will come. That will come. We're still seeing exits. I think probably you can say the same, David and Christian. We're getting exits week on week. And they're not all headline, multi-billion exits. But if you build a good company, there's capital to fund it, and there are corporates that want to buy it. Did I answer your American LP question? Sorry.
You did it beautifully, Joe. Christian, I want to call on you to come in and give your perspectives on this.
Yeah, I fully agree with what Joe just said. In terms of Europe, I think the good thing is that the ecosystem, if you compare to previous cycles, has matured a lot, and that will mean there are more people on all ladders, basically, right? On the LP level, on the GP level, and on the startup level. So that should provide some resilience, I guess, for the coming upturn in activity. At the same time, we've looked at the data, and actually the terms of returns you can gain in Europe in VC are extremely competitive, right? And some people, I guess, underestimate that. I guess if you have a couple of more success stories in terms of successful European exits, I think that will probably supercharge the activity in Europe, because the valuations tend to be a little bit lower. And there's still some catching up to do in terms of you compare the fundamentals that are relevant for a healthy ecosystem and the volume and deal activity that you see in Europe.
There's something we've been dancing around throughout this conversation, which is, of course, when are we going to see better times? When is the IPO window going to open? So for that reason, in real, I was almost going to say real debate style to the, very much in topic because of the US primaries. I want to give you just 30 seconds to tell everyone in the audience, when do you think that the IPO window will open, and when will the LPs really come back to market?
I think people are closely watching Klaviyo Instacart, and that could be an interesting barometer for IPOs elsewhere, and to see how the market supports those businesses. So I think we'll know relatively soon whether or not I think there's appetite for further IPOs based on how that goes. I do think things will pick up towards the end of the year. I think conversations I've had with on both the company side and with other LPs, funds, it seems like people are going to really start to think about things towards the end of the year. Funds I know are going out to raise or finish their fundraises starting in September. There was a little summer lull, but I think end of this year or early next year. I mean, I think certainly that's what I hope. Certainly don't have a crystal ball though, so it could be into 24. And then I do think for better or for worse, the interest rate environment's continuing to be monitored in the US, and that obviously has a knock-on effect of other things as well.
Talking about the IPO, I would say there are two levels to answer the question. First one is Europe, and the second one is the US. Because basically, the European listed market has always been very different from the US one, and notably when it comes to tech IPOs. And that's also one of the reasons why most of the successful European companies are not listed primarily or exclusively in Europe, but mostly on the NASDAQ. Again, I don't have a crystal ball either. I hope it will reopen soon, but for the time being, we don't see clear positive signs. For sure, definitely not before the end of the year, and even for 2024, I have doubts that before we manage to regulate a bit more the inflation and other economic aggregates and parameters, we will come back to something a bit more. I would not even say usual, but as we could expect. Talking about the LP eagerness, I would say, to continue to come back to support VC funds. That's a good question. And currently, what we see is that, as I mentioned a couple of minutes ago, we have to substantially increase our part of some funds because there's a lack of LPs investing in the field. More specifically, for sure, for emerging teams, but also for some specific segment of the market, which has always been quite difficult in Europe. I will not say that there's enough money in early stage, but I think there's quite a lot of money still and firepower on the market. Talking about, and I think Michael referred to that earlier, talking about universities, spin-off, technology transfer type of investments, Europe has always been lagging behind all the other geographical areas, and this is still the case. Unfortunately, the Brexit didn't help on that front because the UK market, I think, is the most advanced we have in terms of tech transfer in Europe. We are trying to catch up, but it's very, very difficult to attract investors in that field. And also, there's a lot of education to do at the level of the universities, which sometimes just do not want to share anything. At the same time, the growth market in Europe has always been also quite complex, meaning that most of the runs were led by non-European investors. As a European institution, you can imagine that we are not happy with that. Not that we do want to prevent European companies to grow and expand internationally, but we would like actually to have them remaining European a bit longer and to remain in Europe. And for that, you may have heard about an initiative that we launched at the beginning of the year, actually called the European Tech Champion Initiative. I saw you made a post on that a couple of months ago, so I'm sure you're familiar with that as well, which is a fund program of almost 4 billion euros dedicated to invest in funds investing in European growth companies. But those funds have to have a size of a 1 billion euros minimum. The purpose of that is not just to make it a nice marketing communication type of thing. Okay, we have reached the 1 billion threshold. It's just that below this size, you are not considered as a serious international competitor by non-European investors. And with that, we hope that we will be able to put on the market or to help having on the market maybe 10 teams between now and in 2-3 years' time, so that there will be more options for European entrepreneurs when they have to raise bigger rounds and growth rounds. So putting all these elements together make it like if we had some nice pieces of a puzzle, now we have to assemble everything to make it work again. No, not that it's broken, but that it has been discontinued. And we would like to have this a bit smoother now. We cannot force anything, but we can continue showing strong signs. And also, coming back to the performance topic, DPI is definitely great. It's not the sole element, but again, if we only look at, we have been promoting a lot the European VC market for years. We started by showing on a slide the number of European unicorns. I'm not particularly eager to back unicorns only, but I prefer what we call the dragons, in funds. But still, 10 years ago, let's say we had 2-3 logos on the slides. Now we need basically almost one slide per vintage or every other vintage to be able to put everything on the slides. So it has to continue. Now with this crisis, the number have decreased for sure. And we have seen a number of companies facing issues, still raising but at lower valuations, which raise a question for in terms of performance for later stage investors. But all of these elements together make us think that we have very nice perspective. It's just that we have to be patient, as Joe mentioned. This is a business where you cannot assess the performance every other day. We have to keep this in mind, and investors as well. And sorry if I've been longer than 30 seconds.
I was just about to say that this is the LP quickfire version. So that's why we booked 90 minutes for the whole session, and we know that we're going to do a quickfire, and that's going to be 5-minute answers per one. Nonetheless, I do think that we should not shun the details and nuances here, and that is why we have EUVC and not something that would try and get everything done in 20 minutes. So for that reason, Christian, let's get to you and ask you the same question.
So my impression is that, or actually what we discussed earlier, that if the main issue that LPs are still on the fence, and of course the question is like what would get them to join the field again. I think some aspect of it is time, right? So the over-allocation issue hopefully will recede a little bit. But then I guess the success stories of IPOs are really important, which of course leads to the question, when are those going to take place? I think Michael mentioned a few trailblazer companies, and what we know from conversations with our more late-stage managers is that, of course, those companies in their portfolios are watching them quite closely. And I guess if the economy holds up and those trailblazer IPOs are successful, then they will be very quick in basically filing their IPO request, just because it's also a pressing issue for them, right? Hopefully, when that takes place, the LPs will be quite quick to follow, because at least from, again, what our managers can tell us from their past fundraisings is whenever there are IPOs, the LPs will pick it up, especially those LPs that are maybe not in the market for a long time, and they will be basically take this as a sign of the future when the IPO takes place, even though I think we probably agree that it would make even more sense to basically split your allocation a little bit more and deploy over more vintages. Yeah.
And Joe, now I'll ask you to come in the end on this. Feel free to go on a super long rant.
Well, you know I love going on a super long rant, so don't give me permission, for God's sake. No, quick on the original IPO question. I'm kind of in the same opinion of Michael. I think there's a few marquee IPOs coming, particularly ARM, that a lot of people are watching. And as those go out, I think ARM is going out with a target of 50 billion, something like that. This is not a venture-backed company. It's an older tech company making chips that we all use, very important company. So to see the investor appetite for that, I think will inspire. Will others launch their IPOs, or will they hold back? I think based on that and Instacart and a few others, you could see the IPO window coming back open again. But I'm also going to agree with David that we just don't have a good tech IPO market in Europe. I think government investors have done such a great job of fixing the private market. I wish they could fix the public market in the sense of having more analyst coverage on tech IPOs, having more education for investors that you can have really strong public tech returns in Europe. That hasn't been the case over time. So companies that can IPO in the US or do a dual listing, they do. And they get better, a lot more interest, better pricing, and so on. I hope in the future that will be more broad, but that's our experience. We had 8 IPOs in our portfolio in 21, and you saw just very different pricing, the ones that went out in the US and the ones that went out in Europe. With similar fundamentals, you get a better pricing in the US. Hope that changes. David, can you fix that for us? That'd be really nice.
And we have the whole panel smiling to those only listening in and not watching the video. I actually have kind of a comment / question on the original question of when will the IPO window open again and LPs come back, and it's connected to the latter part of that question, which is LPs coming back, right? And I think two of you, if not all of you, have already said that, long-term / professional LPs just keep on investing, keep on supporting their existing relationships that won't necessarily change substantially. But from my perspective, I agree very, very much with Michael's timings of when I think like things will gain some clarity on the IPO side of things. But I think we'll see a huge kind of delay from that happening if it's in 3 months, 6 months, a year, whatever that is, into more capital coming in. And I also think there's going to be a huge difference moving forward. And now, like long-term thinking, right? I think the last 2 years we saw an explosion, right? It's and if we kind of try to normalize the data that we have historically, that's just completely like not normal. So I think just the concept of saying when will the IPO window open again, I think it's very important to clarify that, at least from where I'm standing, that doesn't mean we'll see as we saw in the last 2 years, right? It's going to be very, very different from that. I'd love to hear you guys comment on the duality of it, of what is the opening up again and how it will impact, new capital into VC.
I think one point just to add to that's a bit of a nuance is, sure, we can talk about the IPO window, but I think we can also talk about exits in general. And others will be better placed to speak on this than I will. But what I will say to open that up is that I think you're probably going to see a lot of fundraisers where fund managers think about taking secondary on some of their existing portfolio to show DPI, maybe as inducements for new investors coming in, things of that nature. But secondaries will be a big part of helping usher in an era of exits and helping LPs see some liquidity, and then either re-upping or new LPs being able to say, okay, these fund managers have had some exits. So I think that's another piece of this conversation. It's not IPOs necessarily, but it's a really important piece of the conversation to grease the wheels. So others are better placed to do that as they spend time in this professionally. But I think from kind of outside in, I think that's an important piece of this as well.
Are we seeing a too hard of a push on DPI on managers today from LPs, causing them to maybe, for them to be able to raise the fund that they're in now, they're seeing we need to start get DPI on the fund that we're running, and for that reason they're actually being pushed to exit too early, or feeling that push at least, not for actually the final maximum DPI, but because they just need to show DPI earlier and feel that pressure because they know that they're coming to market with the next fund. I'm curious if you're seeing any of that behavior and you're seeing VCs reaching out on your LPAC saying, how do you navigate this? Because we have a bunch of investors writing us every week. When are you getting out of that company?
The quick answer is no. I don't see it. It's a gentle pressure.
Yeah.
There's a real form of pressure, which is LPs saying we can't re up until we have some APR because we're using those distributions to fund our future commitments. So that's a genuine, it's not pressure, it's just the reality of the market. But you have to remember, venture is very different than buyout. For example, in buyout funds, you own the company, you control the exit. You can start a process and sell a company. In venture, you're a minority investor and you're one of many. So you aren't in that control position of saying, I will sell now. What you can do is influence in your position as a board member. You can also influence the team in a soft way, saying, okay, we think it's time. You can also accept secondary offers to buy. And I think that's dried up to some extent. We saw that a lot in the hype cycle. SoftBank would come in and try to buy early investors out, or Tiger, or groups like that. That's happening less, but that still happens where, the growth investor comes in and wants to own the larger piece, and they say, well, can I buy? So we always encourage that at the right time, maybe you sell part of your position, but I think that's also this kind of secondary exit for the very early investors is a healthy thing. That's not happening as much now, but you're not in the control position, so you have to be open to these kind of other ways of exiting or partial exiting along the way.
Yeah. And on this note of then talking tactics, I want to go into the question of what considerations are you seeing managers having today in terms of going to market and preparing for a fundraise now or running a fundraise now, and what tactics have you seen being successful? And I will ask David Dana to start here. You've got a bunch of first time funds, second time funds. They're now getting ready to do this, do their next fund. What considerations have you seen be super valuable that they have, and where would you say maybe managers should be a bit more thoughtful here?
So something which has evolved definitely is the fact that over the last 5-10 years, most of the teams that we saw came to us maybe not as one of the potential first anchor investors. They came with already a couple of millions from a family office or whatever, and then they tried to raise from us and other institutional. Nowadays, we see more and more of them who try to secure, to the extent possible, a firm commitment from a big LP like us or anyone else before going and starting really fundraising on the market. I think this dynamic changed because, as we said, it's more and more difficult, especially for first-time teams, to raise money. As I said, we are not shy on backing first-time teams, but we will not back a first-time team just for the sake of having a new player on the market if it doesn't bring anything different. Meaning that we have backed a lot of investors, we have a huge portfolio, there are lots of VCs in Europe. If it's just about adding a new team which will just come and compete against all the other ones, it will not make sense for anyone. Then if they come and bring something different, they have a particular USP that they can evidence in the way that potentially they have a specific particular sector focus or a particular expertise, networks, way of investing or selecting the companies, anything which makes them unique and capable of being selected by the best entrepreneurs to become part of the game. So then we start talking about something more concrete and that we can try to substantiate a bit. And smart advice as well is that they should not come in a very aggressive position. We've seen a number of them last year and the year before, actually, thinking that because we claimed and because this is what we do, that we would be continuing supporting the market heavily, that it was something kind of granted to them to come and have a kind of box-ticking approach, meaning that, okay, we do this and that, this is part of what is your objective, you have to back us. And if we say no, then they start complaining, trying to activate any kind of link they have with a politician or someone in the European Commission or wherever to make us change our mind, which is even worse because it just confirms that we made the right decision. Be smart, be sure of what you want to do, and be sure that you can do it well. And then if you're convinced about what you're selling, it will be easier for you to convince other people that this is what they have to invest in. Just to give you the way we see it, in terms of EIF processing, we as front officers in the investment teams, once we are convinced that we need or we want to back a team, whatever the reason, we are the best advocate of the team internally. But still, we have to convince many other people. It's not because we think that this is an investment we should do or we want to do that it's done. We need to convince our colleagues from risk management, from compliance, from legal, all of them to make sure that, first of all, it fits with what we can do, but it makes sense. And then our top management and our board. So we have several layers and type of entities or people or counterparts internally to convince. So be sure that you convince us, you convince the people you're talking to that you're good at what you want to do. And then it will be already a good start.
Michael, I would love to ask you, because we had a conversation about this before, and you brought out some really good points, salient points on incentives to get investors over the line. Both, if you could comment on how important they are, and also on which ones you've seen being effective and which ones, like pressure on political personas that are less effective.
Yeah, I think, look, as an early kind of as a manager, first time or early on in the process, I think doing things like offering co-investments or doing a few deals early out of the fund or even through SPVs can be a good way to demonstrate, what an XYZ fund deal looks like, so people can understand, they can actually visualize and see, okay, this is a deal that they would do. I think that's going to help more and more. We've seen a few managers come to market with a few deals that they've done, and that's helping them then get additional LPs. So I think that can be really important. There's obviously a balance to that too. You don't want to do too many SPVs as a way to kind of get started and build a track record, because then if LPs allocate to them, particularly in this would probably be more for the family office community, they might allocate. Then they do enough of those, they may not allocate to the fund. We've seen that happen too. So I think there's a real balance between kind of showing enough skin and then not showing too much when fundraising. So I think that's one piece of it. I think related to that then gets to, what is the minimum viable fund and what does that look like? So really thinking through, if it's going to take longer to raise a fund, what does the minimum viable fund look like? And then if you are going to do a first close so you can do some deals, how big will that be? And then how many deals can you do? So I think those things and really understanding that math are going to be important. I think related to that too, and I would echo David's point and just say it in a slightly different way, which is I think managers who can clearly articulate their edge are going to have a real advantage in fundraising. That's what we look for. And just to give some examples to it, I think managers who can articulate their edge in a sentence or two, and we as LPs can articulate their edge. I'll give you some examples. Goodwater, data-driven venture capital, Tiny VC, indexed exposure to Europe at pre-seed and seed, lower carbon, great brand, Chris Sacca, one of the best, emerging managers, kind of pioneered SPVs, done a lot in climate himself. Like you can clearly encapsulate what managers are doing. I'm sure you all have examples in your portfolio. I think that ends up being a really important thing for LPs to be able to say, okay, this is what makes this manager different, and this is why they're going to succeed. So as a fund manager going out to raise, really think through how to articulate what your edge is and what your difference is, because otherwise it's going to be hard for LPs to say, hey, here's another early stage fund that we can get exposure to, but what really makes you different?
Christian, I'd love to ask you to come in on this and build on what Michael just said.
Yeah, sure. I mean, I can maybe comment on what is important to us when teams come in, and maybe focusing a little bit on emerging managers, because I think there are some additional topics that are important. And the first I would say is like how you build the team, right? I guess for us and many other institutional investors, if you do an emerging manager, you want to be extra sure that the team has a relevant experience. So when you set up your team, if you take on board people who have a good track record in terms of doing investments, but also showing some exit activities, for us very crucial. And then I would say, if you approach the LP, do it as early as possible, right? So that don't basically anticipate a commitment, very much before any relevant closing, but do it as early on as possible. Be transparent in terms of information requests. You'd be surprised, like the difference in the decks you see, like how open points are laid out and not. I would say what is also helpful, especially in this field, is that you are firm on valuations and you can basically talk about your portfolio. When was the last round? What were your considerations, for example, for keeping an older valuation? That is basically on the investment side. And then in terms of the fund setup, clean structure is always preferable, right? So if you have outside parties receiving carry, or there is just a very strong key man issue. I mean, in that kind of market, I guess it makes it a little bit more difficult. And lastly, the terms and conditions of the fund, at least for us, it's also very important that you are down to earth, right? So I think the super carry was very prominent in 21 and so on, but you should be able to defend that based on your past performance, right? So I would say those are some points that are important to us.
Christian, just one thing to add on the super carry, and that's something which is always striking us, is that some teams, and sometimes with basically no track record, ask for a super carry but are not ready in return to get a lower carry in case of a lower performance. Because typically when we have to agree on the super carry, which happens usually more with the established teams, we also ask for a decreased carry. Typically they ask for 25 or 30% beyond a certain threshold. We said, okay, but from the hurdle rate up to, let's say, 2x net performance, then you will only get 15%. Because why would you be getting more if you do more, but not less if you do less? So it's always a question of negotiation, but also trying to promote this best market practice and pari passu treatment.
Joe, I always call you the architect. We just put out an episode today that where I think I introduced you as such. So now we're into the nitty gritty negotiations and deal terms and so on. Tell me, Joe, what would you advise specifically on terms when it comes to a manager getting ready to raise in this market, be that an emerging or an established? Should an established give better terms in quotation marks compared to what they did 2 years ago, 3 years ago?
Oh, well, for new teams,
I love this side, Joe, by the way. Like this dude asking tough questions at this time of the day.
I don't think this is what any of us enjoy spending our time on, put it that way. I not if you agree, but David and Christian, I think we'd all say the same. We'd love just standard terms, just go down the middle. So then we can spend our time discussing investment thesis and companies and how do we have a big outcome together. Whereas tweaking stuff on the edges, it's just annoying. And in Europe, we have very strong standard VC terms driven in large part by EIF, because over the years, EIF has been the largest investor and has had a very clear definition of what it wants and what it doesn't want. And that's been net a good thing, I believe. So most funds we invest in, we don't really spend a lot of time discussing it, especially if EIF or KFW maybe or others have already spent, half a year.
Yeah, we do.
I know. So that's good and bad for us, because by the time they reach us, we say, okay, if you've already been, if David's been beating you up for half a year, then let's talk about something else. But my feeling, particularly for new funds, is you need to make it as easy as possible for investors to join you. So don't, create a nice smooth road they can drive down. Don't create bumps and difficulties through what you may think is innovative. And then, I kind of agree with you, David, on the super carry point. Okay, if you think you deserve higher performance, then you should also give lower performance if you perform well. We're trying to put terms in place for an unknown future. But my favorite is just vanilla down the middle, keep it simple and spend your time focusing on what's this thesis. But, in a bigger picture point of view, I think what we just heard from both David and Christian is they are really spoiled for choice as investors. There's so many funds out there, and every manager thinks they have the best idea and their fund is the best. They're the first doing this. They're not. You're not. In fact, we're all seeing lots and lots, in the same way a VC sees lots and lots of companies. You have to make a selection. So you'd better, by the time you go to Christian or you go to David, you better have a pretty compelling thesis and a team that can execute and a strategy that really can drive value, because there are lots and lots of people trying to do similar things, and you have to compete. So I sometimes call them, you're a fundpreneur, and you have to bring all that cool marketing stuff that Michael mentioned about the crisp marketing message and the strapline. That's true on company level, also true on fund level. You got to bring that to shine out above the rest and get anybody's capital. And it's interesting to hear it from David. I think part of the market sees the governmental investors like an automatic cash machine. Oh, I'll just go down there and take out, my anchor commitment. No, you won't. You need to be bringing something better.
And something also, which is very true on top of that, is that the alignment of interest is also key. Meaning that for sure, keeping it simple with standard terms make it easier for everyone. And sometimes there can be exceptions, but in particular cases. But the main purpose of that is to keep the interest aligned between the GP and the LPs. Because at the end, if things go well, we are super happy that they all become super rich. That's the rule of the game. But if things go less well, we can lose basically everything. It's not for the team in return to become rich based on management fees, for instance, only. So we have to find the right balance to make it workable and viable for everyone.
Could I ask you, David, because even though you all laughed in agreement and nodded when Joe said, we don't enjoy negotiating. This is not the part of our job that we really love. That's not what we're here to do. Nonetheless, and I'm trying to tease out a bit about the dynamics of a fundraise, right, for everyone listening in, because you've got the behemoths like all three of you here. You can cornerstone a fund if that's what you want. That also means that you are the ones typically setting the terms. But David, as an example, it takes quite some time to get through your process, and from point A to point B, where you might get that commit from the EIF, you will also have been raising from others, and those others may have pushed for other terms, or you may have okayed something with them that's a bit quirky and that kind of thing. Could you shed a bit of light to the audience on how they navigate that, how a VC navigates that best when they're talking to a cornerstone investor like you here?
Our processes are quite long indeed, but what we almost systematically do is that we start working with the team sometimes even before they formally apply to get a potential commitment from EIF. So since day one, and what we always recommend to the teams is that once we have a kind of common understanding that there are chances that we move ahead, then we also start agreeing on the main terms. Because if they agree with something which is just not acceptable to us, it might come back later as a no-go for us in the process, and also for a potential other LP. So we always recommend that we discuss any unusual request from a potential large LP or LP beforehand, officially or unofficially with us, but at least we can provide feedback so that if we are at the end in a position of committing, it will not become a blocking point. So yeah, that's something we typically do. There are things that we don't like, but we can accept in certain occasions, things that we are just not capable of accepting because we are not allowed to do so. So we can always provide more feedback also on potential flexibilities that we may have. And depending on the number of elements, if it's an investor without which there will be no fund at all, even with us, then potentially we can be a bit more inclined to accept something for one generation of fund, and then for the successor one, not agreeing with it anymore. So it depends on many elements. So it's really on a case-by-case basis that we assess that. But there is a kind of common grid on what we can accept or not, which is in a kind of term sheet that we share with each and every GP when we start discussing more seriously with them.
You go, Michael. You look like someone who had something incredibly important to say on this.
I don't know about that, but I do think that as someone who is not necessarily in the same position as the three of you, and would rather see all of you on the so-called cap table or LP list for fund managers, I think what I would say to fund managers is really be judicious about what you're giving early on as inducements to try to get to a first close, or if you're not going to have an anchor, or you're talking and you're getting commitments beforehand, like from a family office or otherwise, be really careful and judicious about giving certain terms, because it'll actually hurt your chances of then working with a true institutional investor. And as someone who would invest alongside those institutional investors, not always, but I think we'd prefer to, because I do think that venture or the LP game are both team sports, that we'd rather wait and see a high quality institution come in, similar to the way a round would work for a company, kind of lead terms, really be able to institutionalize the fund, because that will help them build their fund over multiple generations. Because ideally, if you have an institutional investor like the three of you, they're going to end up committing not just likely to one fund, but to multiple funds. So you're really building a franchise or a business. And I think as LPs, we would rather see that as well. And I think that ends up being a good signal. So important to know how and when to deal with both early LP conversations, and to David's point earlier, it's good to get some momentum, have family and friends or some family offices say, hey, we're interested, we want to commit, or we have committed, but really take the time to think who you want to have as your anchor or true institutional LPs, and don't damage the potential for a relationship with them by trying to create a dynamic of having certain terms that then make it harder to unstick.
Maybe to give you a concrete example, that what was a little bit of a red flag for us, if during the process you learn about stuff like the GP and the LP are sort of in a special relationship, right? And you realize only after a while that basically the GP wasn't independent from the LP, or there was like the LP had an option to buy part of the GP or stuff like that. That if you're upfront about it, then you can discuss it. But if it just comes out later on, that's quite unfortunate.
You refer to when family offices start VC funds. That's the most common case, I think, and they own it at some point. And then, we struggle with that as well. And lots of groups like that, we said, well, if you ever go independent, we'd be really interested to invest. But, we believe in treating all LPs equally within the LPA. So that's kind of important. I think most groups get that and then evolve over time. Hopefully you have that experience too.
It's funny that you both mention it, because that's something that we've heard a lot as well, and they even reach out to us asking like if we have opinions, which is funny because we don't really. To be honest, we talk with guys like you and then we echo that. But I'm just curious to hear as well any solutions that you've seen work within those settings. So family office launching these VC funds, and kind of the setups that work. Is it like just pure independent structure that has them as a standard LP? Any tips there that you can share? Because I also know quite a few emerging managers that listen into our podcast that actually find themselves in that situation where this is an incredibly important pool of capital for them, but they don't want to shoot themselves on the foot in terms of not being able to raise more after.
The most obvious is if you try to become independent from whatever entity, should it be a family office or corporate or whatever, start with the name. Already it will give a strong signal.
So
and then
don't call your fund X from family office X, right? Try to change it a bit. Use Y maybe.
Yeah, seems obvious to me, but you never know. No, but basically it's about the again, alignment of interest and real independence, because we all have a different definition maybe of what independence means. But in a way, it's about being independent in terms of decision making, investment, divestment, and being the one deciding in terms of governance of the management company as well.
If you have a GP removal clause, but the anchor investor who was your previous owner can actually block the GP removal, that would a concrete red flag.
I love you, Michael, because as David said, we have many in that position listening in, and you were, for the attentive listener, from Broadhaven Ventures by Broadhaven Capital. And you do invest principal capital. And I'm sure that you've probably gone through that process of thinking, do we want to do one thing or the other? So I'd love to hear kind of your pros and cons on that, not specifically to your case, but in general.
There's both sides to it. We've seen with some managers who we have worked with or are going to be working with, where they've spun out from other entities, whether it's larger institutional family offices, corporates, et cetera. It can be beneficial to have and show some affiliation. I think in some cases, changing the name can be a good thing. In our case with Broadhaven, we felt because of the brand that we've built on the advisory side and in financial services broadly, having the same name would actually be helpful. And I think that has helped. I can't say we've done a great job of marketing all the time. We that took time and a process, because I think we've generally just tended to be more about doing than marketing. Over time, I think that's had to change, because it's important to be out there and have a platform. I do think content creation, as you all are doing, and I'm sure as a number of your managers are doing as well, is becoming an important piece of VC, so people understand who you are and what you're doing. But we felt that having a brand affiliated with our broader business would be helpful and resonate, and I think that's been the case. So I think in our case, it was a conscious decision to keep the brand, and that has been helpful when it's come to larger institutions knowing who Broadhaven is on the venture side, companies saying, oh, we can help from seed all the way to exit. And we have, in a number of cases, we can connect to financial institutions from our relationships we have 75 people on the investment banking side, 13 partners, many of whom were senior bankers, partners at Goldman, vice chairman of Morgan Stanley's investment bank, people like that. So that ends up being really helpful. So I think it really just depends on the DNA of the firm and what you want the brand to be. I think the broader point, though, I would say here is that it's not necessarily a bad thing to have a sole LP or a backer and use that as fund one, either fund two or whatever the number of fund generations that is in terms of investing and building a track record as a team. I think that's where LPs are really going to ask the questions are, have you had a process, a repeatable process with a team that's invested before? sure, you had one LP and maybe there were certain terms and ways of investing. Will that be the same when you go out and raise capital from others and have relationships with multiple LPs? So I think that's the big thing. And if you can prove that that's the case, then it's fine. It's just under either a different brand or a slightly different probation. But that's, I think, the most important thing that LPs are going to look for is this a repeatable process? And are you going to be doing the same thing with the same team that you did before?
All right, ladies and gentlemen, thank you very much for listening into this LP Roundtable. We had the pleasure of welcoming Christian Roehle, Head of Investment Management at KfW, Joe Schorge, Founding Partner of Isomer Capital, David Dana, Head of VC Investments at EIF, and Michael Sidgmore, Co-Founder and Partner at Broadhaven Ventures by Broadhaven Capital Partners. If you enjoyed this episode / Roundtable, drop us a review, follow our podcast, and subscribe at EU.VC. And thank you so much for tuning in today. And again, thank you to our esteemed panelists for being here with us.
This was their finest hour.
Tear down this wall. It's more than just an alliance. This is a union of values.
United and determined, we can serve as a model for other regions of the world.
The nature of a problem requires a European response.
Europe is a story of new beginnings, new beginnings.
Let's start acting.